$15,000 is vanishing from your retirement fund right now, and your index fund company doesn't have to tell you about it. Here's the math nobody on your 401k statement wants to spell out. The average index fund charges between 0.05% and 0.20% in annual expenses, according to SEC filings. On a $200,000 retirement portfolio, that's 0.10% average fee costs you $200 per year. Sounds harmless. It isn't. Over 10 years, that quietly compounds to $10,000 to $20,000 in fees you'll never see itemized on a single statement, and most pre-retirees never even think to look. Stick with me, because in the next 4 minutes, I'll show you exactly where those fees hide, what they cost you in real dollars, and the 3-step strategy to claw back thousands before you retire. You might be thinking, but I've already invested, it's too late. Not true. The sooner you spot these hidden fees, the more you keep. Let's start with the fee structure most people miss entirely. The Investment Company Institute studied 500-plus index funds in 2024, and here's what they found. Expense ratios are just the surface. There are also 12b-1 fees, marketing charges, administrative fees, and what's called cash drag, the cost of holding cash to meet redemptions instead of staying fully invested. On a $200,000 portfolio with a 0.15% combined fee rate, you're paying $300 annually. Over 10 years with 6% average market returns, that fee drag compounds to approximately $15,000 in lost retirement income. That's not a rounding error, that's the difference between retiring at 67 and retiring at 68. But here's the thing, it gets worse. SEC regulations require funds to disclose expense ratios, but they're buried in the prospectus, a 40-page document most investors never read. A 2023 study by Morningstar found that 72% of investors couldn't name their fund's expense ratio within 0.10%, they don't know what they're paying. And because index funds look identical, they all track the S&P 500, investors assume the fees are the same. They're not. A Vanguard S&P 500 fund charges 0.03%. The same index at some regional brokers charges 0.18%, that's 0.15% gap on $200,000 compounds to $30,000 over a decade. You could be in the wrong fund entirely without realizing it. Now let's re-examine this. You're not just losing money to fees, you're also losing the potential for growth. If you had invested that $15,000 in a low-fee index fund, it could have grown to $25,000 or more over the same decade, depending on market performance. That's $25,000 you could have had for retirement, but instead it's gone. The hidden cost I teased at the start, tax drag. This is where index funds get dangerous for pre-retirees moving money around. When you switch between funds, which many investors do when fees are buried, you trigger capital gains taxes. A single reallocation with a $50,000 gain at 15% long-term capital gains rate costs you $7,500 in taxes. One move. That's why fee audits matter before you retire, not after. Consider this, if you make 3 such moves, you're looking at $22,500 in taxes alone. That's a significant chunk of your retirement savings. So how do you fix this? First, pull your fund prospectus right now. Find the expense ratio, usually labeled as net expense ratio. If it's above 0.10%, you have options. For example, if your current fund charges 0.15% and you switch to one that charges 0.05%, you could save $2,000 over 10 years on a $200,000 portfolio. Second, compare to the lowest cost alternative. Vanguard's VFIX S&P 500 costs 0.03%. Fidelity's FSCAX costs 0.015%. If you're paying 0.15% or higher, you can lower your cost for free by switching within the same account type. No tax consequence in a 401k or traditional IRA. Third, calculate your actual fee impact. Take your balance. Multiply by your current expense ratio, multiply by 10. That's approximately what you'll lose if nothing changes. For $200,000 portfolio at 0.15%, that's $30,000 over a decade. Once you see that number, the switch becomes obvious. But here's an additional step to consider: consolidating your accounts. If you have multiple accounts with different institutions, you might be paying more in fees than necessary. By consolidating, you can simplify your investments and potentially lower your fees. For instance, if you have 2 accounts with $100,000 each and you're paying 0.10% in fees for each, that's $200 in fees per year. If you consolidate into one account with a 0.05% fee, you'll save $100 per year, or $1,000 over 10 years. The SEC is tightening disclosure rules as of 2024, which means you'll soon see fees listed more clearly. But you don't have to wait. Audit your portfolio this quarter. Most pre-retirees can cut their costs in half with 3 phone calls and 0 tax consequence. That recovered $10,000 to $20,000. It stays in your retirement account compounding until you need it. That's the difference between a golden retirement and one spent worrying about money. Imagine being able to take that dream vacation or spoiling your grandkids without worrying about the cost. That's what recovering these fees can do for you. Knowledge compounds, stay focused. Remember, every dollar you save in fees is a dollar that can grow for your retirement. Don't let hidden fees erode your retirement savings. Take control and start building the retirement you deserve.